Building wealth requires time. If a portfolio is left alone, small contributions begin compounding, eventually reaching a scale that far exceeds the initial investment. However, this process is frequently interrupted by the escalation of commitment. This behavioral bias leads us to increase our investment in a failing strategy, simply because we have already spent significant time or money on it. This happens because of loss aversion. The psychological pain of a financial loss is roughly twice as intense as the joy of a gain. So, as this chart shows, the investor tosses another bag of money into the decline, hoping to buy their way back to the break-even point. You see this in investors refusing to sell a stock until they get their money back, business owners who drain personal savings to sustain a bankrupt model, and professionals who stay in unfulfilling careers because they spent years earning the degree. This creates a difficult balance. Success requires determining exactly when the virtue of persistence ends and the vice of stubbornness begins. We can navigate this by applying a diagnostic framework. The first step is to evaluate how much you have changed since the plan began. Research indicates that adults consistently underestimate how much their goals and values will shift over time. This explains why only 27% of college graduates work in a field related to their major. The person who finished the degree is often different from the person who started it. This timeline illustrates the conflict. While a 30-year financial plan is a straight line, real life is a diverging path. Holding on to a strategy that no longer serves your current identity is the definition of a sunk cost. Financial stability depends on building structural flexibility into your roadmap. By maintaining a high savings rate and a margin of error, you retain the ability to change direction as your priorities evolve. Discarding an outdated goal preserves the resources needed to fund your next chapter. The second diagnostic test is determining the nature of the loss. You have to distinguish between a threat to survival and simple market noise. Certain assets suffer from a broken thesis that leads to total capital depletion. When an investment's value is driven towards zero by structural failure, the loss is permanent. In these cases, math requires cutting the loss immediately. Saving even a fraction of your capital is better than letting a single bad bet wipe out your entire portfolio. But we often mistake broad market volatility for this kind of terminal failure. During a general market sell-off, the floor becomes chaotic. Panic is contagious, and it becomes tempting to sell everything just to stop the stress of seeing your account balance drop. Investors accept these fluctuations as a standard requirement for long-term gains. Dips are the fee you pay for historical returns, not a sign that the system is broken. Panic selling during these cycles guarantees wealth destruction. It forces a temporary decline to become a permanent loss and prevents you from participating in the eventual recovery. Using this matrix, you can categorize a loss correctly. If an individual asset is failing, you exit. If the broader market is simply turbulent, you stay the course. Reframing your perspective turns quitting into a tool for capital preservation. Exiting a bad position ensures you have the resources to find a better one. At its core, the goal of all investing is survival. You want to stay in the game long enough for the math of the market to work in your favor. Survival requires managing two psychological extremes: the stubbornness that keeps you in a bad bet, and the fear that makes you drop a good one. If you avoid these behavioral traps over several decades, you become eligible for the market's highest rewards. This bell curve shows why. Most investments yield average returns, but a tiny sliver, about 7% of companies, drives nearly all long-term wealth. You cannot predict which stock will become a tail event. To capture these returns, you must remain in the market through every dip, ensuring your capital is present when rare winners emerge. Flexibility is a more valuable financial asset than blind stubbornness. By knowing when to walk away from a mistake, you gain the opportunity to stay for the success.